What actually triggers a stock market crash? And can we predict when the next one will happen? To understand this, let's journey back to 1929, a year that changed the landscape of finance forever. Picture a bustling Wall Street, full of excitement as investors eagerly buy stocks, believing that the good times will never end. It's like a carnival, with everyone cheering as stock prices soar to dizzying heights. But what happens when the music stops? Enter our protagonist, a man named Charles, a confident broker who's riding the wave of prosperity. He's convinced that the stock market is on a never-ending upward trajectory. But beneath the surface, something is brewing. The economy shows signs of instability, yet investors ignore it, caught up in the euphoria of rising prices. Here's where it gets interesting. This overconfidence leads to speculation, where people are buying stocks not for their underlying value, but simply to sell them at a higher price later. And then, the surprising part, on October 24th, 1929, known as Black Thursday, reality hits hard. Panic spreads like wildfire as stock prices plummet. Investors, like Charles, rush to sell, but there are no buyers. This is a classic example of a market crash triggered by a sudden loss of confidence. The more people sell, the faster prices drop, creating a vicious cycle. So, can we predict these crashes? Well, while certain warning signs exist, such as excessive speculation or economic downturns, no one can pinpoint the exact moment a crash will occur. Market psychology and human behavior are complex, making predictions notoriously tricky. In the end, understanding these dynamics can help us navigate the unpredictable nature of the stock market. If you found this insight helpful, consider subscribing for more clarity on market mechanics. Imagine it's the late 1920s, and the stock market is like a carnival, bursting with excitement and anticipation. Investors are eager to jump in, riding high on the wave of rising stock prices. It's a wild game of musical chairs, with everyone scrambling to secure a seat before the music stops. But here's the surprising twist. Many of these investors aren't using their own cash. They're borrowing money to buy stocks, a practice known as margin buying. Let's break that down. Picture a group of friends at a fair, each wanting a piece of the action. Instead of paying full price for their tickets, they ask the ticket booth for a loan, promising to pay back later. This is essentially what investors were doing in the stock market. They would put down a small percentage, say 10%, of the stock's price and borrow the rest from their brokers. This allowed them to buy more shares than they could afford outright, amplifying their potential profits. But here's the catch. While margin buying can lead to big gains when the market is climbing, it also introduces significant risk. If stock prices start to fall, brokers can issue what's called a margin call, requiring investors to either deposit more money or sell their shares to cover the loan. This creates a domino effect. As prices drop, panic sets in, triggering a wave of selling. So, while the market was booming and everyone felt invincible, beneath the surface, the foundation was fragile. Investors were playing a risky game, and soon, they would find out just how precarious their positions really were. Understanding this dynamic is crucial, as it sets the stage for the dramatic events to come. Imagine you're in a crowded marketplace, and you spot a stunning piece of art. It's priced at $1,000, but you only have $500 in your pocket. Instead of walking away, you decide to borrow the extra $500 from a friend, promising to pay it back later. You purchase the artwork, and if it appreciates in value, you stand to make a nice profit. After all, you only invested half the amount. This is essentially how margin buying works in the stock market. In the 1920s, the buzz of the stock market was intoxicating, much like that art piece. Investors were eager, and many turned to margin buying, borrowing money from brokers to buy more stocks than they could afford. A common practice, it allowed people to amplify their investments. For example, with just $1,000 in cash, an investor could control $2,000 or even $3,000 worth of stocks. It felt like wielding a powerful lever. Small investments could yield large returns. But here's the surprising part. This same leverage can work against you. If the stocks you bought with borrowed money fall in value, your losses can multiply just as quickly as your gains. In our art analogy, if the piece you bought drops to $800, you're not just losing the $200 you put in, you still owe your friend the full $500. This was the ticking time bomb of margin buying in 1929. When a market took a downturn, many investors faced margin calls, brokers demanding payment for the borrowed funds. Unable to sell their stocks fast enough to cover these debts, panic ensued, leading to a catastrophic sell-off. Ultimately, margin buying contributed to the massive market crash that year, proving that while leverage can amplify gains, it can just as easily amplify losses if not handled with care. Understanding this mechanism reveals how quickly the tide can turn in the markets. So, what's the next step in unraveling the mystery of stock market crashes? Let's dive deeper. Vocabulary: margin, leverage, amplify, market crash. Imagine a bustling marketplace. It's alive with energy, people exchanging goods, and prices rising steadily. Now, picture that same marketplace suddenly gripped by panic. As stock prices began to tumble, investors who had borrowed money through margin buying faced a new reality: margin calls. It's like being told by your bank that you need to put in more cash to keep your loan active. When those margin calls hit, investors had no choice but to sell their stocks fast. Picture a fire alarm going off in that marketplace. Everyone rushes to the exits, trying to sell their goods before prices drop even more. But here's the surprising part. In moments of panic, when many are selling, not many are buying. It's a classic case of supply outstripping demand. As stock prices fell, each forced sale put downward pressure on prices. Imagine a game of hot potato where everyone is desperate to pass it on, but no one wants to catch it. With each sale, prices kept plummeting further, creating a vicious cycle. The more people sold, the less buyers were willing to purchase at those falling prices. It's like a snowball rolling down a hill, growing larger and larger as it picks up speed. With each successive drop, the market lost confidence and the selling intensified. The atmosphere became charged with fear, and what started as a ripple effect turned into a full-blown avalanche. Stocks that once seemed stable now felt like quicksand, dragging everyone down with them. This cascade of selling led to what we now recognize as a stock market crash, wiping out billions in wealth almost overnight and leaving everyone in shock. Understanding this cycle of margin calls and panic selling helps demystify why crashes happen and why they can feel so sudden and catastrophic. The dust settled after the 1929 crash, and investors were left with shattered dreams and dwindling portfolios. But amidst the chaos, a crucial question emerged. How could this happen again? The answer led to a significant shift in how the markets operate. Picture the financial landscape as a bustling marketplace before a thunderstorm. Everything looks lively until the wind starts to change. After the crash, regulators realized they needed to install some umbrellas, protection for investors and the economy alike. This is where the Securities and Exchange Commission, or SEC, came into play. Think of the SEC as the market's lifeguard. Its job is to ensure that everyone plays by the rules, keeping the waters safe for those willing to dive in. They monitor trading practices, enforce regulations, and require companies to disclose important financial information. The idea was clear. Transparency breeds confidence, and confidence is essential for a healthy market. Yet, here's the surprising part. Despite these protections, predicting the exact timing of a market crash remains as elusive as catching smoke with your bare hands. Markets are influenced by countless factors, from global events to investor sentiment, which can shift in an instant. Even with rigorous oversight, no one can truly foresee when the next storm will hit. So, while regulations like those set by the SEC help mitigate risks, they can't erase the inherent unpredictability of the market. Investors must always prepare for the possibility of downturns, learning to navigate the waves rather than waiting for clear skies. In this ever-evolving landscape, understanding the mechanisms at play becomes crucial for anyone looking to engage with the markets responsibly and knowledgeably. Imagine a bustling marketplace where vendors shout their prices and buyers eagerly exchange their hard-earned cash for goods. This is not unlike the stock market, where the value of companies is negotiated every second. But what happens when panic sets in? When the marketplace suddenly quiets and everyone rushes for the exits? The mechanisms that lead to a stock market crash often begin with margin buying. Picture a buyer who borrows money to purchase more shares than they can afford. This creates a leverage effect. A small price drop can lead to significant losses. As these buyers face losses, they receive margin calls, demanding they either deposit more money or sell their shares to cover the loans. And here's the surprising part. This selling can trigger a domino effect. As one person sells, the prices drop, causing others to panic and sell as well. The market starts to spiral downwards, much like a game of Jenga, where one piece pulls out and the entire tower begins to wobble. But it's not just margin buyers. Economic news, interest rates, or geopolitical tensions can spook investors, leading to a mass sell-off. Think of it as a flock of birds suddenly taking flight. One startled bird leads to a chain reaction, and before you know it, the sky is filled with panic. While we can't predict exactly when the next crash will happen, understanding these mechanisms gives you the tools to navigate the marketplace more wisely. Recognizing the signs of panic or identifying when market sentiment shifts can help you make informed decisions. So, if you want to dive deeper into how these mechanisms work and stay ahead of the curve, you know what to do. Subscribe to our channel for more insights that turn confusion into clarity.